Hey guys, so today we're going to talk about something that happens in the market all the time, every day, that if you are trading and you want to understand liquidity-based trading, you have to know that this is happening in the market. It's very important. So we're going to talk about how smart money exploits key stop loss and buy stop levels in the market. Okay, so how smart money exploits key stop loss and buy stop levels is core to mastering liquidity-based trading. There you have it. So first we're going to talk about what smart money knows, what the banks and what the institutions know. They know where the retail traders commonly place stops and entries in the market. They know that there's liquidity at these spots. At these spots, there are clusters of stop losses and pending orders, which equals liquidity. And they use that liquidity to fuel their own large positions. Okay, now they're not waiting for price to get to this point. They're not chasing the price. They are able to create price moves that trap or trigger retail traders. Okay, so the next section we have, they hunt liquidity, not price. So in order to fill their huge, massive orders, the institutions need a liquidity pool. Stop losses and buy stop orders equal liquidity pool. It's what they are. There's a bunch of liquidity at the stop losses and the buy stop orders. So retail stop clusters equals free liquidity. An example is going to be below swing lows, there's going to be a lot of sell stops, and above swing highs, there's going to be a lot of buy stops. And smart money knows this, and they're coming for you, retail traders, you and me. They're coming for us. They know we do this. Okay, so smart money sees these levels not as support and resistance, but instead as liquidity that they can just snatch up. Okay. Oops. The stop hunt and liquidity sweep. So we're gonna say price is in a certain range. Retail traders are gonna go long, and they're gonna put stops under the ranges low. Smart money knows this, and they're gonna push the price down because they're able to do that. Loud ass noise coming by. So smart money pushes the price down because they are able to do that. They sweep all of those stops that they know are there, causing all of the retail traders to do forced selling, and then they buy into that sell side liquidity. After this, the price will reverse violently upwards, leaving retail confused and also trapped. So this is called a liquidity sweep, a stop run, a false breakout. You can call this any of those things. Okay, so the buy stop trap. Above resistance or recent highs, retail will put buy stops anticipating breakout trades. They think a breakout is coming. There are so many signs that a breakout is coming. They're like, woohoo, a breakout's coming. I'm gonna put my buy stop here so I can get in on this. Well, smart money knows that, and smart money buys price up to these stops, triggering all the breakout buyers. And then they sell heavily into these buy orders because now there's a ton of liquidity for them to be able to do this, and there's a ton of liquidity for them to be able to exit or short from. They can short off of this. So after they do that, price then, they are able to make then price slam down right after a fake breakout, and this will trap late buyers. Late buyers will arrive. They'll be like, ooh, yeah, I'm gonna get in on this breakout, let's go. And then no, bad news for them. Okay, because the big institutions and the banks are ahead of them, and they are using they're tricking them, because they're easily trickable, because most of trading fails, and then they're sweeping all this liquidity and they're doing whatever they want with it. Okay, so how are they pulling this off? Well, they use fake structure to bait the traders. They will create a convincing structure. They will make it look like they'll let it break in one direction. They will make it seem like there's a break of structure, which it might actually look like there's a break of structure. So a lot of people will then buy into this, and then they reverse after collecting all of the liquidity from those retail stop orders. So after taking out all of these stops, smart money can do one of two things. They can either accumulate buying below a liquidity sweep, or they can distribute sell above it. So these areas become the actual start of the move, and not the move itself. It's kind of interesting, right? So what we can do with this when we're trading is we can mark obvious retail stops where we know below swing lows and above swing highs there's going to be a bunch of obvious retail stops, and we should be expecting liquidity grabs before big moves. Okay, watch for break of structure after liquidity sweeps, and big picture is figuring out how to enter with smart money instead of against it. So I hope this video was helpful. I'm gonna put all these notes from the video also in the description, and I think like watching this a few times will be helpful, as well as if there's something you don't understand, take that and research that information until you do understand it, and then like watch the video again. So far in my trading journey, I have watched like hundreds of videos, but also re-watched them like 5 times to understand what's being said. So that's okay if you need to do that. This video might not have been, you might not have understood this 100% straight away, and that is totally okay. But anyway, let me know if you have any questions, and give me some feedback on if I'm making these videos good or bad. Thank you.